You can survive the next financial shock if you understand one ugly pattern, but you will not survive it if you keep treating money like luck. The painful truth is this: every major crash in modern America has had a real spark, and it almost always starts where regular people can't see it: commercial real estate. Then it spreads like a virus into jobs, banks, and your paycheck. And in 2026, the system is lining up for another round of that same logic, only the damage will be harder to ignore. This is not financial advice, this is financial education. What you are about to hear is analysis of how credit, interest rates, housing, and banking mechanics actually move through the economy, and why the public keeps missing the moment the fuse is lit. You were taught stories that make you feel safe. You were told recessions come out of nowhere. You were told inflation is just a temporary annoyance. You were told if you work hard and save, you will be fine. In 2026, the data says those stories are comfort blankets, not explanations. Here is what we will do. First, we'll look at the recurring cadence of modern American crises and why the timing matters less than the mechanism beneath the timing. Then we'll zoom into commercial real estate, the part nobody wants to talk about because it sounds boring, until it destroys thousands of workplaces at once. After that, we'll connect the dots to the Federal Reserve, because people obsess over the headline interest rate while the real action happens in the Fed's balance sheet and credit plumbing. Then we'll come back to a single question you need to answer for yourself tonight. If the next domino falls in commercial real estate, what breaks first for someone like you, and what do you do before it breaks? Now let's start with the part nobody wants to admit out loud. People argue about whether history repeats. They call it superstition, confirmation bias, or a coincidence dressed up as insight. But when you see the same failure chain show up again and again across decades, the pattern stops being mystical and starts looking like a system design. You've probably heard the slogan that every 18 years the United States gets hit by something big. Whether you believe in the number itself or not, 18-year cycles line up with a very specific kind of credit behavior. Debt takes years to mature, refinance risk builds silently, and then a wall of obligations arrives when rates are wrong and asset values are lower than expected. The crash isn't a meteor, it's a timing problem, it's a balance sheet problem, it's a refinance problem, and the public only notices when it becomes a headline. Think about what happened around the early 1970s. Yes, people point to oil. Yes, energy shocks matter. But the deeper story is that the credit engine was already stressed, and the foundation beneath asset prices was already failing. When the market tries to reprice risk, the first place it hits is usually property and leverage, because property is where banks store their assumptions. When those assumptions crack, every related promise cracks too. Then fast forward about 18 years, you get a new global narrative, the geopolitical storyline, the end of a competing bloc, the idea that the opponent disappeared so the economy should naturally stabilize. But again, if you strip away the storytelling, you see the same mechanism. Credit and property were already fragile. The market does not wait for world politics to decide its health. It follows the arithmetic of debt service and collateral values. Then you fast forward again to 2008. The public remembers a single villain, a firm that collapsed. But the collapse of one bank is rarely the root cause. It is the notification system. 2008 was the moment when people finally understood that the trigger is not a company name. The trigger is millions of borrowers failing at the same time because the underlying asset price and loan structure were incompatible. In plain language, people could not pay. That failure hit the collateral. And once collateral falls, every financial institution is forced into a painful choice: sell assets at low prices or stop lending to protect itself. Either choice hurts the real economy. Here is where it gets uncomfortable. Since 2008, the system has become better at hiding the early stages of the same problem. It doesn't prevent the mechanism, it delays the moment it becomes visible to you. It moves the pain from obvious defaults into quieter terms like refinancing risk, occupancy risk, and loan maturities. It turns a crisis into an invoice. And now you are in 2026, staring at a wall of maturities in commercial real estate, and you are being told to keep calm because inflation is down on a chart, and because central banks still exist, and because stocks go up sometimes. But the market that matters most for your paycheck is not the one with chart emojis. It is the market where banks decide whether to extend credit and where property owners decide whether they can pay next year's principal. So let's talk about the part you have probably ignored because it sounds like office buildings and boring leases. Commercial real estate is not one market, it is dozens of markets stitched together by one thing: leverage. When a commercial property owner buys with debt, their entire plan is built on one fragile equation. Rent must cover expenses and interest, enough occupancy must exist to keep rent stable, and property prices must hold, so refinancing later is possible. In 2020 and 2021, the equation looked solvable because money was cheap, then rates rose, then work patterns changed. Then the equation turned into a trap. After the pandemic, remote work and hybrid schedules rewired behavior. Not because everyone instantly stopped working in offices, but because employers learned they could run operations with less physical space. If half the meetings become online, and if new hires require fewer desks, you don't need to renew leases at the same scale. You can downsize, you can consolidate, you can negotiate harder. And the negotiation advantage shifts toward tenants, not landlords. Now combine that with inflation-driven cost pressure, and you get a brutal reality. Office buildings did not just lose tenants, they lost bargaining power in negotiations about rent increases. And when rent growth stops, the market starts asking a different question. Not, is this building profitable? Instead, can this building service its debt at today's interest rates? According to available sector data and the pattern across major United States markets, the vacancy problem is not a rounding error. Vacancy and distress indicators moved in ways that remind people of earlier cycles, but with a twist. Remote work changed the demand curve, not only the supply. So even if the economy slows and interest rates eventually fall, the demand story may not snap back to the old equilibrium. And here is the part nobody wants to say, because it sounds like personal tragedy. When occupancy drops, landlords lose cash flow. When cash flow drops, they struggle to service their debt. And debt service is not optional. Banks don't negotiate daily about whether a landlord feels like paying. Payments are scheduled. And when payments are threatened, banks tighten their standards, which makes refinancing harder, which increases defaults, which makes banks tighter again. That is how you get a feedback loop. Let me give you a micro story, because numbers without faces are abstract, and abstract is how you get fooled. Picture a 32-year-old facilities manager named David. He works for a mid-sized company in a tech-adjacent business. In 2019, his employer leases office space near a major city center. In 2020, suddenly half the staff is remote. In 2021, the company realizes that remote is not just an emergency mode, it's an efficiency strategy. In 2022, they cut the lease footprint. In 2023, they renegotiate rates. David's job still exists, but the building around him changes. Maintenance hours get reduced. He sees fewer deliveries. He hears rumors of tenants relocating. In 2024, the landlord tries to keep the lights on by offering concessions. They lower rent. They offer months free. They promise they can release. David's building becomes half occupied. And the building's owner starts getting calls from the bank about covenant issues. Not the dramatic calls, the technical ones, the paperwork ones, the ones where the bank says the risk has increased and the loan terms might change. Then, in 2025, the landlord faces maturity, not interest, principal. The loan comes due, and the building cannot sell for what the loan needs it to sell for. Refinancing is possible in only one world, a world where occupancy improves quickly and rents rise and property values stop falling. But in the real world, David's building has vacancies that make it difficult to even justify optimistic rent projections. David doesn't personally own the building, but when the landlord's cash flow breaks, his company might not renew. Or the company might relocate to a cheaper building and David's role might be merged. Either way, David's paycheck becomes a negotiation variable inside someone else's balance sheet. That is how commercial real estate becomes your problem. And now, let's connect the dots to what you were taught about inflation and the Fed. Most people track interest rates like they are a weather forecast. They see that the Fed might cut, and they think everything will heal instantly. But the Fed has multiple levers, and the lever that matters for commercial real estate is not just the overnight rate. It is liquidity and balance sheet decisions, and it is how credit markets behave when refinancing becomes expensive and when capital is redirected. In 2026, a key idea is that the Fed is expected to end certain balance sheet tightening actions. That sounds like relief, and it can be in some markets. But the mechanism is subtler than the headline. Liquidity is not automatically free money that shows up in every borrower's bank account. In practice, balance sheet changes can shift which assets are supported, which markets get funding, and how stress travels from one corner of the system to another. Commercial mortgage lending is long duration. It is not overnight. It is not a few days. It is loans that sit on bank books or in securitizations for years. When refinancing is needed, lenders look at risk and price loans based on current market funding costs and expected credit losses. If the Fed is no longer buying certain mortgage-backed securities in the same way, the pressure can shift. Mortgage-backed securities markets can reprice. Banks can reduce exposure. Investors can demand higher yields. The result is that the cost of long-term financing can remain high even if the Fed cuts the overnight rate. In other words, the headline interest rate might move, but your actual refinance rate can still be brutal. Now here is where the narrative becomes sharp enough to cut. People assume that if rates eventually come down, then every stressed borrower gets saved. That is not what the credit system is built to do. The credit system is built to survive defaults, not prevent them. It survives by transferring losses and by raising standards until the market clears. When enough borrowers fail, the cycle ends. Until then, everyone is scrambling. And in 2026, refinancing pressure is not theoretical, it is concrete. A huge amount of commercial property debt, particularly in the United States, is coming due. The debt was issued when rates were low or when valuation assumptions were optimistic. Then rates rose. Then property values fell. And then demand shifted due to work patterns. Now the loan maturity calendar forces owners to refinance at worse terms, or sell at worse prices, or default. This is the moment when your 2020 knowledge becomes irrelevant. A lot of people in 2020 and 2021 believed the future would be smooth because the Fed was low-rate friendly and because it felt like the world had paused and then resumed. But they missed the refinancing clock. They missed that low rates don't eliminate risk, they hide risk. They missed that fixed-rate loans can protect certain borrowers at first, like a bandage, but bandages come off. And when the bandage comes off, the wound is still there. So why is 2026 so dangerous? Because for many commercial properties, the grace period of cheap or fixed financing is ending. Owners who were able to make it through the initial rate shock now face the maturity wall. A key example. When a loan is originated, the borrower locks into a specific interest rate for the fixed period. During that fixed period, their debt service is predictable. But the borrower is not just paying interest, they are also buying time. When the fixed term ends, they must refinance based on current conditions. If rates are higher and if property values are lower, refinancing becomes harder or more expensive, or both. And if the property cannot generate enough cash flow at the higher cost of debt, the owner's options shrink rapidly. The crisis becomes a choice between bad outcomes. The owner either keeps paying with squeezed cash and hopes rents recover fast enough, or they sell into a weak market, or they default and hand the asset back. Those outcomes are not evenly distributed. Some owners will survive, many will not. That's what makes the crisis look uneven at first and then catastrophic later. Now let's talk about how unemployment spreads, because people keep thinking a financial crisis stays inside markets. It does not. When commercial property debt gets stressed, lenders cut credit. When lenders cut credit, small businesses that rely on loans get squeezed. When businesses get squeezed, they cut employees, and when employees lose pay, they cut spending. Reduced spending reduces revenue. Reduced revenue forces more layoffs. This is the financial version of a winter storm. The snow starts somewhere, but it ends up burying everything. In major city centers, vacancy rates can reach alarming levels in office properties, sometimes approaching levels that were considered extreme in earlier cycles. When office occupancy falls, the ecosystem falls with it. Restaurants, coffee shops, gym memberships, retail around transit, cleaning services, security providers, construction firms that were building for future tenants. It is not just a building, it is an income machine. And when that machine breaks, even government budgets can get hit because tax receipts linked to property values and commercial activity fall. This is where you stop seeing layoffs as random. You start seeing budget stress as a political and administrative domino. Now, you might ask a fair question. If this is so serious, why doesn't the entire system collapse overnight? Why did 2008 become obvious over time? Why hasn't 2023 to 2025 already turned into full-blown economic catastrophe? Because the system is designed to delay the visible stage of failure. It uses accounting tricks, refinancing windows, maturity ladders, and regulatory relief. It uses the fact that banks can survive losses if they slow down lending and if they hold assets long enough for the market to stabilize. It also uses the fact that defaults don't happen in one day. They happen when the maturity clock hits, and that delay is exactly what makes people complacent. You're alive in the almost period. You're watching not yet events. You're hearing officials talk about stabilization. You're seeing stocks recover in bursts. And you think the worst is behind you. But the worst is often behind schedule. It's waiting for the maturity calendar to hit. It's waiting for a refinance wave. It's waiting for credit standards to tighten so much that borrowers can no longer buy their way out. This is why the recurring cycle idea matters. Not because 18 years is magic, but because credit cycles have timing. Debt issued in cheap times matures years later. If the macro environment changes before those maturities, the risk is not just increased, it becomes concentrated. Concentration turns manageable stress into acute crisis. And in 2026, the concentration is high. Now we need to widen the lens to understand why the public is not reacting with the same urgency it did in earlier crises. You have more distractions today. You have constant social media narratives about passive income. You have a creator economy that sells freedom while thousands of people earn nothing and post anyway. You have AI making people afraid for their jobs, which is real. And while you are anxious about AI, the financial system quietly changes around you. AI is disrupting employment faster than most people predicted. It changes hiring. It reduces middle-class demand for clerical and routine roles. It pressures wages in some sectors while concentrating profits in others. It can raise productivity for companies, but that productivity often doesn't translate into broad wage growth. The result is a labor market that feels unstable even when headline unemployment looks tolerable, so you're already stressed. Then inflation quietly erodes purchasing power, even if headline rates cool. In many cases, real wages recover slowly, if they recover at all, and housing stays detached from earnings. In the United States, the United Kingdom, Canada, and Australia, people watch home prices rise while their wages stagnate. They do not need a financial conspiracy to see the mismatch. They live inside it. So when your rent rises and your savings don't keep up, you start looking for relief. You gamble on assets, you buy narratives, you believe the system will eventually return you to a fair deal. But in a credit-driven crisis, fairness is not the goal. Solvency is the goal, and solvency favors whoever has collateral, whoever has access to liquidity, and whoever can borrow at reasonable terms. If you don't have those advantages, you get slower than everyone else at reacting, because you cannot afford to overreact. This is why the retirement crisis makes everything worse. Pension underfunding and aging populations create future liabilities. Social security pressures rise. If government budgets tighten due to weaker property-linked tax revenues and slower economic activity, then retirement systems that were already strained become even more strained. When people are forced to delay retirement, they remain in the labor force longer. That can suppress wage growth. Then consumption weakens further. Then companies cut costs. Then layoffs happen. It is a cycle of stress that multiplies. Now consider global debt, which exceeds $300 trillion worldwide. That debt is serviced in a world where interest rates are not what they were in the era of near-zero borrowing costs. If enough borrowers default and refinancing costs rise, you get a credit contraction. That contraction reduces demand. Reduced demand reduces revenues. Reduced revenues increase defaults. That is the virus. And while this is happening, financial institutions and regulators can be cautious. They can slow the pace of failure to avoid systemic collapse. But slowing failure does not remove failure. It just stretches it out, which is why you experience it as a long, uncomfortable squeeze, rather than one dramatic collapse. Now here is the part that should make you feel angry, because you have been lied to in a very practical way. You were told that housing and investing were safe because diversification exists. You were told markets always recover. You were told if you just buy index funds and keep investing, you will be fine long term. But this story assumes the long term is not hijacked by policy decisions and by balance sheet mechanics that protect certain players while forcing others to absorb losses. In 2020, when rates were near zero and money was abundant, asset prices surged. Meanwhile, ordinary wages did not surge at the same pace. That gap matters. If you are not buying assets with easy leverage, you are watching the world price you out. You feel like you are working, but your purchasing power isn't improving. Then the narrative flips. People say, don't worry, inflation came down. But inflation is not just a number, it is a lived experience. It is the cost of groceries, insurance, rent, childcare, and healthcare. Even if inflation slows, your wages may not catch up to the new reality. That is why people say they feel poorer. It is not irrational, it is arithmetically correct. Now add crypto to the mix, because people love to pretend it is an escape hatch from traditional finance. In theory, crypto was supposed to remove banks. In practice, in many ways, large financial institutions and market makers gained the advantage. Regulation and institutional adoption changed the ecosystem. By 2026, you can argue that retail participation is not driving outcomes the way the early dream promised. Institutions can build positions and control liquidity. That means the freedom narrative often becomes another mirror that reflects financial power, not removes it. And while retail watches chart candles, the real damage comes through debt, refinancing, and asset collateral. Crypto may move, but the mortgage clock doesn't care. Your lease renewal doesn't care. Your bank loan maturity doesn't care. Now let's come back to the core mechanism, the fuse. Commercial real estate debt is coming due in clusters. In 2026, a large portion of fixed-rate windows ends or refinancing needs intensify. Some owners can roll loans by borrowing more against weaker collateral values, but banks are not handing out money generously when losses are rising. Banks become risk managers first, lenders second. So when a borrower goes to refinance, they face two problems. Interest rates for new loans are higher than the rates on their old loans, and the loan amount they can borrow is lower because banks haircut the collateral value. If you previously borrowed $100 million against a property valued high enough to support that loan, and the property has dropped in value, the bank might only approve $40 to $50 million. That means the borrower now must produce the difference as cash or face default. That difference can be enormous. And it is not theoretical, it is a quarterly spreadsheet reality. At the same time, if occupancy is down, rent may not increase enough to cover higher interest expense. So even if the borrower can refinance partially, the debt service burden increases. Cash flow gets squeezed, then maintenance gets delayed, then tenants get worse service, then tenants leave, then vacancy increases again. That is how a decline accelerates. Now, the system reaction matters too. When banks face stress, they tighten standards, they lend less to everyone. That includes small businesses, construction firms, and consumer-facing enterprises. If you live in a city, you feel that tightening is fewer projects, fewer expansions, and more hiring freezes. And here is where the 2026 transition becomes terrifying. In earlier cycles, you could sometimes guess the timing based on public panic. In this cycle, panic lags behind the mechanism. People only panic when liquidity is already gone. They panic when credit becomes unavailable, not when the maturity clock was already ticking. So you need to treat late signals as too late signals. Now let's talk about what happens when defaults rise. A lot of people imagine it as a simple story. Borrowers default,